Most people think the stock market is a giant voting machine. Buyers, sellers, price discovery, pure capitalism doing its thing. But what if I told you the world's largest free market might not be as hands-off as we think? Because while we point fingers at China for having a state-influenced market, the United States may be quietly doing something surprisingly similar. Not by sending government officials to ring the opening bell. Not by announcing, hey, we're buying stocks today. But through policies, systems, and safety nets that'll lead to the same place. Higher asset prices, softer crashes, investors who believe someone will step in. And once that belief takes hold, markets don't behave the same way anymore. Today, we're breaking down how the US supports its stock market without officially saying it does. Why that looks a lot like China's playbook. And what that means for us as long-term investors. Because whether you love it or hate it, understanding the game matters more than arguing about the rules. Most people grow up with the idea that the stock market in the United States is the definition of a free market. Prices move because millions of investors make independent decisions. Companies rise and fall based on performance. Risk is supposed to be real, and failure is supposed to be possible. That belief is so baked into how we talk about capitalism that we rarely stop to question it. The market is seen as a scoreboard, not a tool, and definitely not something the government would ever touch on purpose. But that picture starts to blur when you look closely at what happens during major financial stress. When markets fall hard enough, fast enough, the conversation changes. It stops being about letting inefficient companies fail and starts being about protecting jobs, protecting retirement accounts, and protecting the broader economy from spiraling into something worse. And right there is where the line between free market and managed outcomes begins to fade. No one from the government is logging into a brokerage account and buying shares of tech companies on a random Tuesday. That part is true. There's no official announcement that says, we are supporting stock prices. But markets don't just respond to direct buying. They respond to liquidity, confidence, and the belief that the financial system itself won't be allowed to collapse. And that belief is shaped heavily by the actions of the Federal Reserve and other policymakers. When the Fed cuts interest rates aggressively, it doesn't buy stocks, but it makes safer assets like bonds pay less. That pushes investors out on the risk curve. Pension funds, insurance companies, and everyday investors start looking for better returns. And a lot of that money ends up in equities. When the Fed provides emergency lending programs or steps in to stabilize credit markets, it doesn't purchase shares directly, but it reduces the odds of a full-blown financial freeze. Companies can keep borrowing. Banks can keep operating. Investors feel less fear about the entire system breaking down. That shift in fear levels alone can change market direction. Because stock prices are not just math, they're expectations about the future. If investors believe that worst-case scenarios are less likely because policymakers will step in with liquidity, they demand a small-to-panic discount. Prices recover faster. Dips feel more temporary. The floor under the market starts to feel a little more solid. Even if no one officially admits there's a floor at all. Over time, this creates a subtle but powerful feedback loop. The more often markets see strong policy responses during crises, the more they begin to anticipate them. Instead of pricing in the possibility of total collapse, investors start pricing in intervention. Risk doesn't disappear, but it gets big drops feel like events to manage, not endings to endure. The narrative slowly shifts from the market can do anything to the market can do a lot, but there are limits to how far it will be allowed to fall. That doesn't mean the system is fake or completely controlled. Companies still go bankrupt. Bubbles still form and burst. People still lose money. But the idea of a totally hands-off market becomes harder to defend when you zoom out and notice how often stability is treated as a policy goal. Supporting employment, consumer. In China, the idea that the government might step into the stock market, ESNT, a conspiracy theory, or a hidden backstop. It is something investors openly talk about. There's even a nickname for the collection of state-linked institutions that are believed to support markets during periods of sharp declines. The national team. It doesn't refer to a single trader or one giant fund, but rather a network of government-affiliated entities that can deploy capital when volatility threatens financial stability. Some of the organizations often associated with this role include firms connected to the state's financial system, such as China's Securities Finance Corporation and investment arms tied to sovereign structures like Central Hygiene Investment. These entities have, at various times, been reported to purchase large-cap stocks or exchange-traded funds during steep market selling. The goal isn't to pick the next high-growth company or to outperform a benchmark. The goal is stabilization, slowing panic, restoring confidence, and preventing a downward spiral from spilling into the broader economy. This approach makes more sense when you consider how closely financial markets are linked to social and political stability in China. A large number of retail investors participate in the stock market, and sharp, prolonged crashes can lead to public dissatisfaction and loss of confidence, not just in markets, but in economic management overall. From a policy perspective, allowing extreme volatility to run unchecked can be seen as a systemic risk, not just a financial one. So, intervention becomes less about market purity and more about maintaining order. When heavy selling begins, these state-linked buyers can step in as a kind of shock absorber by purchasing shares of major companies or broad market funds. They add demand at moments when private investors are rushing for the exits. This doesn't necessarily reverse a downtrend overnight, but it can slow the speed of the fall. Slower declines give regulators, companies, and investors time to adjust. Panic is often fueled by velocity as much as magnitude, and reducing that speed can change the psychological tone of the market. The presence of a perceived national team also affects behavior even before any buying happens. If investors believe that authorities are likely to step in at certain stress levels, they may be less willing to sell aggressively into weakness. That belief can dampen volatility on its own. In that sense, the policy tool isn't just money, it's expectations. Markets are forward-looking systems, and when participants think there's a backstop, they price assets differently than they would in a purely hands-off environment. Of course, this kind of involvement comes with trade-offs. When people hear that the government might be supporting the stock market, they often imagine something dramatic and direct, like officials placing trades or announcing a price target for an index. In the United States, it doesn't work like that. The approach is far more indirect, woven into the plumbing of the financial system in ways that look like stock buying on the surface, but can still have powerful effects on asset prices. A big part of this influence runs through the Federal Reserve. The Fed's main tools are interest rates and liquidity, not equity purchases. When economic conditions weaken or financial stress rises, the Fed can lower short-term interest rates, making borrowing cheaper across the economy. It doesn't just help businesses and consumers. It also changes how investors allocate money. Lower yields on savings accounts and government bonds push large pools of capital, from institutions to individuals, to search for higher returns elsewhere, and stocks are one of the primary destinations. This shift is sometimes described as moving out on the risk curve. When safer assets pay very little, investors are almost nudged into taking more risk to meet their return targets. Pension funds still need to hit long-term obligations. Insurance companies still need growth. Retirement savers still want their money to compound. As money flows into equities in search of yield, stock prices can rise even if the original policy decision was aimed at supporting employment or credit conditions rather than the market itself. Liquidity programs are another channel. During periods of severe stress, parts of the financial system can freeze up. Companies might struggle to roll over short-term debt. Bond markets can become disorderly. In those moments, the Fed and sometimes the U.S. Department of the Treasury introduce facilities designed to keep credit flowing. These programs are often focused on loans, bonds, or backstopping key funding markets, not on equities. But by stabilizing credit, they reduce the odds of widespread corporate failures and financial contagion. If businesses can keep accessing funding, investors are less likely to assume a wave of bankruptcies is around the corner, which supports stock valuations indirectly. There's also a structural component built into how Americans save and invest. Millions of workers automatically contribute to retirement accounts tied to the stock market. Every paycheck, a portion of income is invested into diversified funds, many of which hold large allocations to equities. This steady, rules-based buying happens regardless of headlines or short-term volatility. It creates a persistent demand stream that doesn't rely on daily sentiment. Policymakers understand how central these accounts are to household wealth. So decisions aimed at protecting jobs and income also help maintain the flow of contributions into financial markets. Then there's the psychological layer. Over decades, markets have observed that during deep crises, authorities tend to respond forcefully. Rate cuts, emergency facilities, and coordinated fiscal measures have shown up repeatedly when conditions deteriorate fast enough. Investors internalize that pattern. Even without an explicit promise, many start to assume that extreme downside scenarios will trigger some form of response. That's one of the biggest shifts that happens in a market where intervention is expected. ESMT mechanical, EDS psychological. Over time, investors stop thinking only about earnings, growth, and valuations, and start thinking about the likelihood of a rescue. The belief that policymakers will step in during severe downturns changes how risk feels, and when risk feels different, behavior follows. In the United States, decades of crisis responses have shaped this mindset. When markets experience sharp stress and authorities respond with aggressive measures, investors take note. Each episode becomes part of a collective memory. It doesn't turn into a formal guarantee, but it creates a pattern that market participants learn from. The next time volatility spikes, people don't just ask how bad fundamentals might get. They also ask how policymakers might react if conditions worsen. This is where the idea of a perceived safety net comes in. If investors believe that extreme downside scenarios will trigger strong responses from institutions like the Federal Reserve, they may be more willing to hold risk during turbulence. Instead of assuming that a sharp drop signals a prolonged collapse, they start to see it as a phase that could eventually attract policy support. That belief can reduce the urgency to sell at any price, which in turn can soften the depth and duration of declines. Over time, this dynamic can evolve into a habit known informally as buying the dip. On the surface, it looks like simple optimism, but underneath, it's often tied to expectations about liquidity and intervention. If past experience suggests that severe stress leads to rate cuts, lending programs, or other stabilizing measures, then lower prices can look like opportunities rather than warnings. Investors begin to anchor not only on company fundamentals, but also on the assumption that the broader system will be defended if things get too unstable. This doesn't mean investors become reckless across the board, but it can subtly raise overall risk tolerance. Strategies that might have seemed too aggressive in a truly hands-off environment can feel more reasonable when there's a belief that tail risks are partly cushioned. Leverage can creep higher. Valuations can stay elevated for longer. Market participants may accept thinner margins of safety because the worst-case outcomes feel less probable, not necessarily because businesses are safer, but because the system is expected to absorb shocks. The feedback loop strengthens itself. If enough people act on the assumption of support, that behavior can help markets stabilize faster, which then reinforces the original belief. Shorter, shallower downturns become evidence that the system is resilient and that stepping in during weakness works. Each cycle where policy responses coincide with recoveries adds another data point to the narrative that big declines are temporary interruptions rather than structural resets. At the same time, this mindset can create tension beneath the surface. If prices are supported not just by earnings power but by confidence in intervention, markets become more sensitive to signals from policymakers. A hint that support may be slower, smaller, or less certain than expected can have an outside. When you step back and look at a market where policy support is expected, the conversation naturally shifts from, is this right or wrong, to what kind of system are we actually operating in? Because once government actions and central bank policies become part of the background environment, markets stop being purely about individual companies and start reflecting broader economic design choices. In the United States, one of the clear advantages of a system that leans towards stabilization is the reduced likelihood of full-scale financial collapse. Severe crashes don't just hurt traders. They can freeze credit, destroy jobs, and ripple through everyday life. When policymakers act to calm markets, they're often trying to prevent those chain reactions. Stabilizing asset prices can help preserve confidence, which supports spending, hiring, and investment in the real economy. For long-term savers with retirement accounts tied to equities, fewer extreme drawdowns can mean a smoother path toward financial goals. There's also a planning benefit. Businesses operate more confidently when financial conditions are relatively stable. If companies believe that credit markets are less likely to seize up completely during stress, they may be more willing to invest in expansion, research, and hiring. Households may feel more secure about spending when their savings and retirement balances are not swinging as wildly. In T-Sense, a system that indirectly supports markets can contribute to economic steadiness beyond the trading floor. But those same stabilizing forces can carry long-term when asset prices are consistently supported by low rates and abundant liquidity. Valuations can drift higher than they would in a stricter, more hands-off environment. Stocks, real estate, and other financial assets may appreciate faster than wages or overall economic output. That gap can widen wealth inequality because people who already own assets benefit the most from rising prices. Those without significant investments may feel left behind, even if the broader economy is technically stable. Another concern is the distortion of risk signals. Markets are supposed to help allocate capital by rewarding strong businesses and disciplining weak ones. If financial conditions are persistently cushioned, poorly run companies may survive longer than they otherwise would. Investors might fund projects that look viable only under very easy conditions. Over time, that can reduce overall efficiency, as capital does always flow to its most productive uses, but instead to areas that are best positioned to benefit from abundant liquidity. There's also the question of dependency. If markets become accustomed to strong policy responses during downturns, any future situation where support is limited, whether due to inflation, political constraints, or other factors, can feel like a shock. The system may be stable most of the time, but more fragile in moments when its usual tools are harder to deploy. Expectations built during years of intervention can amplify stress. If those expectations are not met, from an investor's perspective, labeling the system as simply good or bad misses the point. It's more useful to see it as a different set of rules. Prices are shaped not only by earnings and growth, but also by interest rate regimes, liquidity conditions, and the likelihood of policy responses during stress. Understanding that mix helps explain why markets can stay elevated for long periods, why dips are often bought aggressively, and why volatility sometimes fades faster than traditional models might predict. Instead of fighting that reality, long-term investors benefit more from recognizing the environment they're in. That means paying attention to macro conditions alongside company fundamentals, being aware of how policy shifts can change valuations across entire sectors, and accepting that market behavior in a system with active stabilization tools won't look exactly like textbook free market theory. As cycles unfold and the balance between growth, stability, and risk continues to evolve over time, so when we zoom out, the question isn't whether markets are still real or whether capitalism has quietly disappeared. It is about recognizing that the system we invest in today is shaped not just by companies and consumers, but by policy choices that influence how far things are allowed to fall and how quickly stability is restored. China does it in a way that's more visible and direct. The United States does it through interest rates, liquidity, and structures that channel money into financial assets over time. Different methods, different philosophies, but a similar outcome. Markets that don't operate in a vacuum. That doesn't mean crashes can't happen. It doesn't mean risk is gone. It means risk is filtered through a world where governments and central banks are deeply aware that financial markets are tied to jobs, confidence, and everyday life. When asset prices fall hard enough, it's no longer just a Wall Street problem. It becomes an economic problem. For us as investors, this isn't about cheering for intervention or rooting against it. It's about understanding the environment we're actually in. A market with potential backstops behaves differently from one without them.